from Tribeca Investment Partners. Junbei, thank you so much for joining us. Has it been pretty wild from where you sit this week?
Oh, absolutely. I think wild is a too soft a term for us. I think the market's really trying to absorb what does this war mean, and the same as the commodity market trying to really price that in. Earlier on in the week, we did see some alarming signs of credit spread blowing out in European banks and financials because as a result of their linkage to Russia. But we have seen that easing back, and the market seems to be gathering a little bit more confidence back into the market, really.
Yeah, well, where we sit on this Friday, down by about 0.5%. So it looks like we've erased these week-to-date gains, but anything can happen heading into a weekend. So we'll leave that chitter-chatter there. I'll get our viewers across what we will be talking about in the first half of the show. The companies are Aroa Biosurgery, Renergen, Judo Capital, Mesoblast, and Metals X. So quite a motley crew there. But in place of stock of the day today, I thought we'd ask our expert guests for a pick in what's being called the new FAANGs.
Who made that up?
So what's a new FAANG? Merrill Lynch, actually. What's a new FAANG?
Oh, well, it's got to be true.
Well, you must remember that the term FAANG was coined to refer to those top 5 U.S. tech stocks, but with tech on the out, there's a new FAANG in town. So it is FAANG 2.0, and it is fuels, aerospace, agriculture, nuclear and renewables, gold, or metals and minerals. So quite the list there. And I did ask my guests for just one, but they're both overachievers. So they've given me a pick from each of those areas. Adam, you're here with me. Let's start with you. Okay, in the fuel world.
So we're staying Aussie.
Stay Aussie.
Centric for that one. And certainly Woodside.
Yep.
Fantastic.
It's making money hand over fist right now.
It is, and it's also very interesting that once they do this deal with BHP, sort of June 30, they won't have much debt at all. They'll be pretty much clear, free, and in a growth phase as well. So it really sets that company up for a very large 2022, 2023. And certainly from there, Santos as well, starting to run a little bit now. We were sort of, a couple of weeks ago on the show, we were a little bit perplexed why Woodside was running so hard and Santos not. Santos is playing a little bit of catch up at the moment. But yeah, Woodside they're probably a little bit tough up here with oil prices where they are, and I think there will be a little bit more consolidation. But for the safe bet, Woodside, and for all those other people that like a little bit more risk, Santos is probably a good buy.
Got it. Junbei, let's get your picks or pick in that fuel theme.
I know, you got all my top picks. I've got Santos. And but I think I did work out why the differential in terms of performance. It's because Woodside has the contract that they're more exposed to the spot prices. So that literally the high spike in all that energy price goes straight to the bottom line, whereas Santos will take a bit longer because their contracted price is much lower. So I think that's why. But you're absolutely seeing that underperformance is now sort of started catching up a little bit. I still prefer the likes of Santos because Woodside does have that big potential pressure of selling coming through when BHP does split out the Woodside shares to its shares that they'll be selling. But yeah, I absolutely agree. These two stocks will be really well leveraged to the current price.
Yeah, and we spoke with Meg O'Neill, who's the Woodside CEO, yesterday, not ruling out, special dividends, buybacks, because again, their balance sheet is in such good shape, or will be, as they benefit from these rising prices. Okay, Junbei, aerospace. What in that area could you think to pick?
I must say that in that area, it's pretty tough because so in Europe and US is quite a big defense sector, where Australia is quite tiny. So there's one Boats which is kind of exposed to that sort of whole defense spending. But the problem with that stock is that they've got a big earnings hole to fill, and I think in the next 12 to 18 months they have to win a lot of contract to do so. On top of that, I think there's so there's really limited exposure. There's one more actually. I think Adam is going to jump in with that name. EOS, that's it.
Yeah.
Oh, EOS.
Yeah.
Do you like it though, or is this you're being kicking and screaming to this aerospace theme?
Or defense, because it's more defense, and they make guns. So The problem is with this stock and a lot of these defence stocks is that they've got really great contracts with US government or Australian government, those kinds of things. But they trade by appointment, so in other words, it's very lumpy. So if they win a contract, they make a nice announcement, everything sort of goes up a little bit, and then from there sort of comes back down again. So it's really hard to, I guess, plan or invest in these kinds of things. And the chart looks absolutely horrible as well. But you can see every time it's sort of, well, if we overlaid announcements, you'd see that sort of tick up and then come back down. So, and also usually the US government as well as the Australian government, they can, with a stroke of the pen, just terminate that contract and then their business model's gone. So I'll be really careful. I mean, Boeing is probably your biggest bet in that international space. And then there's plenty of US defence businesses in there as well. But, you know, potential Boeing, I think, would be one for investors to look at.
Yeah, and that might have been more interesting if you're talking sort of cybersecurity. But we're not making up rules as we go. So now that I've got you beside me, Adam, Agri. I mean, you should be able to find something Australian listed. Yeah, well, here in this
I think
space.
Jumbo is going to talk New Farm. Maybe I'm speaking a little bit out of turn there, but she likes that one. But I think there's an ETF called Food.
Yeah,
it's a beta shares one. That one has actually done pretty well over the time. Got a little bit of a kick up with that sort of exposure in Europe and wheat and those kinds of things. But Food, FOOD, is a great way to get broader access to the agribusiness space.
Got it. Jumbe, how do you look to play this food inflation agri theme?
Did I get it right, Jumbe?
No, I wasn't going to say New Farm, but New Farm looks very interesting at this point. But I was going to say, look, there's a winner, which is so far that's being GrainCorp. It's not exactly linked to the prices things, but it just we're having all these bumper crop and then now potentially shortage in terms of grain. Because of the war that's happening, and they put them in a good position. So so that stock will do pretty well. There's another one that looks quite interesting. It's been hated for so long and it's had so many problems, and right now potentially having a bit more problem because of floods. It's Costa Group. It used to be one of those favorite stock when the weather condition was okay. They went through hard time during the COVID, and they couldn't find the staff shortages, the fruit pickers, and now finally they've come through, and you're looking at pretty good growth from here on. Now flood is potentially will have some damage to some of their crop, but the company have commented that it's nothing material. So I think altogether it does make that stock pretty cheap, and it will give you pretty good growth for the next couple of years. So that looks interesting in the small cap space.
The other one is probably Elders. We just came out and initiated coverage with a $15 price target on that one, and that's got the bank, it's got all of the agri kind of things, and it's sort of a Macquarie Bank of the agriculture space. That's nice and safe for investors as well to have a bit of a look at. Elders, okay. Nuclear, Adam. Renewables. Yeah. I'll stay in the renewables. I mean, obviously uranium's going crazy at the moment, over $60 a pound at the moment. So absolutely going crazy. How long can it last? Well, potentially it can. Obviously in that sort of uranium space is very, very good. But I've gone with one of the renewables, which is Calix. CXL is the stock code. It's just getting over $7 again today. So $7.16. So really like this one. It's a good little business. They've got lots and lots of things that they can talk to about in their business models. But really what it is one of the biggest things that they've got is that they can take heat out of cement production. Mm-hmm. Okay. I was at a lunch this week where it came up that cement and concrete is like the last frontier in terms of emissions, that they're worse than everything else. Absolutely. And so these guys have got the ability, and it's really like I'm simplifying this, but it's a tube that they put around the smokestack. Yeah, okay. And they're able to take a lot of that heat or the CO2 out of that cement production, and then they basically get royalties just ticking through over the time. And they've got Europe sorted out. They're going to be in the US. It's a great little business. Calix is the one. So that's your pick in the renewables. What about you, Jumbe? Did you go nuclear with uranium, or did you go renewables? Look, I actually am not going to have a pick in this space. I think Calix does sound very interesting, but from memory, I think they don't even start. They haven't even started producing for the contracts. Those contracts. They've got contracts, yes, but the royalty stream hasn't started yet. Yes. Yeah. Okay. Yeah. So I guess for me is that some of those. For me, the issue is that because they're still very, very early stage, but that one certainly looks very interesting. Share price down very well.
But for me, it's still many years away. In terms of the profit, so a little bit early for me, but it's a very interesting sector.
Got it, Junbei. And we'll stick with you, Junbei, in the gold, metals, and minerals. This is quite wide. You can cast your net wide. So what would you pick in that space?
Yeah, look, in terms of gold, it will be my Northern Star as the top pick. I guess the metal, what was the other one? Oh, minerals. Okay, well, look, copper is something I like, and plus is lithium mineral. Yeah, we've got lithium as well, just simply because that structural growth driver underneath them. And, share price being a little bit volatile for the lithium, but it is something you do want to buy on the pullback. Sorry, that is...
No, that's enough.
Yeah.
That's enough. We've got to move on. Adam, what's your pick out of gold, metals, and minerals?
I'm going to stay with the commodity. GOLD is the ETF that I like. Also, PM Gold, if you're looking for something that's a little bit smaller, but also has a lower MER. PM Gold is one, but GOLD is one that we put for clients in portfolios.
Got it. Okay, I don't even think I'm going to be able to read my notes on that one when we get to the wrap up. But guys, thanks for playing along. So those are the new FAANGs, some picks in that space. Let's get on with the companies that have been nominated by you, our viewers. The first on the list is Aroa Biosurgery. I have a tough time saying that. ARX, this is for Shri, saying, in particular, keen to understand Junbei's view, given she was talking about the company a few months ago very highly and had it as one of her strong recommendations for the year ahead. Do you still have a favorable view, Junbei, on the company, and are you buying at these levels?
Oh, absolutely. The company has continued to perform very, very well. So as we know, it's a soft tissue regenerating business. It utilized a more organic type of technology instead of synthetic that Polynovel uses. So the larger peers is Polynovel, and this Aroa actually has better product that has been clinically tested around the world, and it's been used on millions of tests around the world in many markets. So it is tracking very well. The company's earning was impacted by COVID because most of the hospital had to shut down and the like, so it did impact some part of their earning, but it has come back significantly. Now, the company continued to trade at a very big discount to its closest peers, which is Polynovel, with something like 60% discount, which is not justified. So in my view, that will catch up. Now, the reason share price has underperformed is because, whole basket of companies that's not profitable, even though they're reaching profitability in the next 6 to 12 months, but anything that's not profitable has been sold off. You look at across tech or any space. So it just, as an investor, sort of shifting the appetite, from the high growth company into some of the cyclical like resources and others. But I think if you keep it in your portfolio, the company will grow 40-50% for many years to come. And then it's signed up many large hospitals around the world, and the volume will pick up significantly going forward. So, to me, it's something that you buy and you really don't have to worry about what's happening. It's fully funded for all its rollouts. My view is that potentially at some point, it'll become part of a bigger portfolio by other investors, by other companies.
Okay, thank you, Junbei. Do you like it as much as Junbei does?
Look, I can't really say much more. Junbei's done a fantastic job there. For me, just looking at the chart, it's probably a hold for me because that chart just looks like it's moving lower, and at the moment you need to see a bit of a rebase. So obviously they're progressing well. Obviously they got sort of caught up within this coronavirus, which I think they've been unfairly treated. But for me, it's a hold.
Hold, and that's waiting for a turn before you would buy into that one.
Yeah.
Now, Renergen is next on the list. RLT is the ticker code. This is for Steve. I hope you're watching, Steve, or listening. Adam, I'll start with you. No context, but just wants to know about the company, I suppose, if it's a worthy investment. Yeah,
it looks interesting. I mean, they're in a couple of sectors as far as methane and helium. Now, you probably think that that's not a huge area, but it is actually quite big, especially helium, going forward. So their phase 2 or their 2P reserves, they've seen some upgrades in both of those commodities going forward. So I think that looks really good. The reserves, I guess, are much larger than what first projected, and that's what you want in a resource space or a resource type of company. And now I guess they're looking for phase 2 or moving into that phase 2, which is going to be really important. but looking to produce gas in early 2022. So here we are now. So the rubber's got to start to hit the road with this business. They've really got to start to produce. And those helium and gas markets, as we know with all commodities, those commodity prices need to stay strong so they can get them out of the ground and turn a profit. So the valuation, I think, is probably limited here, but I think it looks okay. I'm not a huge fan of the company. I'm going to say hold. If you hold it, you wouldn't be selling it at those prices. That looks really good to me. But you'd wait for a bit of a dip, or basically look for the upgrades in the commodity prices to get that moving forward. So look, I think it's a really good little business and looks okay. Commodities are moving in the right direction. I'd just be holding. It looks pretty good, that chart, but I'd be careful at the moment.
Okay, Junbei, Renergen is the name.
That's right. Yeah, look, it's I kind of agree with Adam, and I think it looks pretty good. Look, would I be chasing it? I wouldn't be chasing it here simply because usually when those little companies, when they start to produce any material, that's when you hit the risk. You tend to have issues with delays and too much rain and all sorts of things. So often people always say you buy them when they have the reserve and discovery and share price run ahead, and then the next 12 months is going to be a bit tough. So but look, they're very, very close to reducing, probably a good thing. You just be mindful of you are hitting a part where you potentially will have some risk coming through. I'll be a holder of it, just simply because similar to Adam, that let your winners run, and things are going well for them at the moment and wrong. So, but you can potentially even take some profit later on as you get close to production.
Got it. Thank you. Let's get on to the next one on the list, Judo Bank. It has declined consistently in price since IPOing, despite seeing growth in the lending book. And our viewer, who is Connor, pointing out that there should be the potential for small business borrowing to pick up as we move through this economic recovery post-COVID. Is it time to buy in? Junbei?
Well, I think with this company, they're kind of in that tough environment, right? So it's one of Australia's newest bank. They only got their license in 2019. They very traditionally, they focus on that SME lending, and then they've grown, obviously significantly purely through the broker channel. And then just in terms of, the problem with companies is that at the moment they're breaking even, so they're not actually profitable. Compared to the likes of the traditional bank, where NAB is normally a very SME focused business. So it's trading at sort of 1.5 times book. It kind of looks okay, but for me, it's like I'm much rather invest in some of the banks at the moment. It's producing good cash flow, very good dividend yields. They're very profitable. If the interest rate going higher, they will be pretty profitable. So, I think I just have a preference for the other larger banks such as NAB instead of this one at this point, given it's not actually breaking even.
Thank you. Adam, Judo Capital.
Sorry, did we just hear Junbei saying that she'd invest in the top 4 banks?
She said NAB in particular.
Yeah, I can't believe that, Junbei. I'll have to call you out on that one next time. But Judo looks interesting as far as that these neobanks should start to, or were expected to start to take market share from the big 4.
Well, we just had today Brookfield buying Latrobe Financial.
Yeah.
So clearly they're saying that there's a real challenger environment here for the big 4.
So there's significant leverage that these guys can have, and it's especially with interest rates rising, there's that NIM, the net interest margin, should start to expand for these banks. But the problem that they've got is they're trying to attract staff, and they're having to pay higher costs to get those staff on board. And I think that's where the net profit, as Junbei rightly pointed out, was net profit was 0.7 million, so $700,000. So they actually broke even, or a little bit of a profit for the year. Revenue was broadly in line with around about 73 million as well. And the solid loan growth as well, they sort of up 38%. So all the metrics are there, but they're getting higher costs. And this is obviously where the banks, the big 4, are basically able to attract the staff, get the right people in the door, as well as then if they need to borrow money, the big banks can basically say what they're going to borrow that money at. Whereas Judo and these smaller ones they're price takers, not price makers. And so that price taking means that net interest margin gets squeezed. Net interest margin is what they get the money for to what they lend us the money, and the margin is in between.
Yeah.
So it's a really tough one. It was going to be a big space, and there was lots of talk a couple of years ago about it, but Judo was really the only one that was able to get listed, and we're seeing that share price not so fantastic at the moment. I think there's going to be some value somewhere along the line, but maybe when interest rates are a little bit higher, maybe that net interest margin starts to move, and then they can attract higher caliber of staff, and I think that's going to be where they're going to be able to get that loan generation book moving in the right direction.
So that's a no for you.
Yep.
Got it. Let's get to Mesoblast. Mesoblast is actually the worst performer on the 200 right now, 12.23, around about there, PM here in Sydney on this Friday. This is a very volatile company.
Too volatile for me.
Too volatile.
Yeah.
It's always hanging on an FDA approval or the
Yeah.
approval of a clinical study, and it's one step away always from raising more cash from investors, correct?
100%. So look, this one, investors will have some long memories on this one, and there'll be a lot of people that have been hurt on this one.
Yep.
Is that they used to do kidney disease or liver disease, and they were able to pinpoint where the cancer was, and they were able to get that out. Now that didn't meet the end primary output, so the stock fell. Now they've been talking about some cardiovascular heart disease, and they're able to do that as well. But however, that wasn't able to meet the end point as well. So look, it's really, really tough, this one. It's way too speculative for me. And and I've talked about this on the show before, and then I've had this email from people, like 15 paragraphs telling me why I'm wrong and why. And there's a lot more people, smarter people than me in the room, and I would definitely, if you know your stuff and you understand the business, go for it, invest it, but it's just way too speculative for me.
Yeah, and so you get emails as well. So do I. Awesome. Junbei, don't know if anybody would email you and be so forthcoming, but what do you think about Mesoblast?
Well, my memory of this stock goes back much, much further than Adam's the pinpoint thing. But doing the spine, they can cure the back pain using stem cell. So, and I remember distinctively for so many of those products, it's always the phase 3 is coming, it's going to be successful, and they have never met any of the endpoints. And then I think they have this amazing way of represented the actual data to make it look really good. And then when you actually read through, well, we didn't get approval. So I just find it incredibly amazing that the stock still is listed and managed to raise so much more money over the years to fund all these new studies. I think one thing ultimately is that they're trying to use stem cell to use that technology, stem cell technology, into so many other areas. Now, if that can be proven successful, even in one area, it will be incredible. I think it will be just mind-blowing, and it can be applied to so many different spaces. The problem is it's such a hard, difficult area. There's a lot of money being thrown at it around the world. I think that's why they're attracting quite a lot of people. But it's very difficult to see. Maybe eventually they'll get it, but it's very difficult as a general investor to really see where it's where it might go.
And then there's opportunity cost as well. I mean, if you're invested in Mesoblast, unless you have an unlimited pool of money, you're not invested elsewhere, right, River? So that is what our expert guests are saying about Mesoblast. And just a reminder, it's information only. This is not for your personal financial circumstances. So you do need to do your own research or get financial advice. Okay, let's get to number 5 on the list. We are back on track, and this is Metal X. Now, Ben references the small cap program last week, and we had a guest on who talked about Metals X, MLX. Now, he said that it's only one of 2 Western listed tin producers, and the company also produces nickel cobalt. So Ben wants to know, what are your thoughts? It's had a very good run, but as my guest last week on the small cap said, it's still trading at a pretty low multiple. Junbei?
Look, it's pretty cheap. It's a baby version of a lot of larger producers. It's in all the right space, copper, nickel, cobalt, all the right space, and which the commodity itself has been running very aggressively. I'll be a holder of it. To chase a small stock like that, I think it does represent a bit of risk. Just especially when commodity prices are very, very elevated because of this war. So potentially you can see pullback, but I'll be a holder at this point.
What do you think, Adam? Metals X, MLX for Ben?
Tin does not excite me at all.
Apparently it's used in a lot of future-facing products. Okay.
Sure, but it doesn't excite me at all. I've seen too many of the smaller cap tin stocks. There was one in Tassie and there was a couple of others, and it's one of those metals that is in abundance and the commodity doesn't really move too much, and so it just doesn't get me excited. Nickel and cobalt, absolutely, it's a future facing metal, and so something like that I think is interesting. But for me, I'd stay in the larger space for nickel and cobalt. So I wouldn't go here. It would be a sell for me. I don't think I'm not that excited about it at all.
Got that. The excitement is not here. All right, we are at the halfway point of the program. So let's summarize the first 5 stocks and the stock of the day. Stocks of the day. So new FAANGs. If you're in the fuel space, Adam would pick Woodside or even Santos. Santos if you've got a little more of a risk appetite. Santos, though, is the pick in the energy space for Junbei. In the aerospace, look, not a lot on the ground here in Australia. Adam nominated Boeing overseas, but really didn't excite the guests. I thought we might get, 4 or 5 buys out of each of them, but did not get that. Although Adam, in the food theme, would look to that food ETF to gain exposure to agri. Junbei likes GrainCorp and Costa, and Adam did a PS with Elders as well. Nuclear and renewables, Adam's pretty keen on CXL, Calix. And Junbei would say, look, if you're in the renewable space, it's more of a lithium story. We'll discuss lithium in just a tick. And for the golds, metals, and miners, in the gold space, Junbei likes the big boys. She likes Northern Star Resources. Adam Dawes would prefer the gold ETF to get broad exposure to the actual physical commodity. So there you go. That brings us to the companies that have been nominated by you. Aroa Biosurgery, so Junbei is still very keen on this one to answer your question, Shri, and she would be buying it now as well. Adam likes the looks of the chart. He's just a holder here, though. Renergen, it's a hold for Junbei. In fact, she says with it very close to producing, when it starts to produce, you might be looking to take some profits because of the state that we're in with these commodity prices. It's a hold for Adam. Judo Capital, Junbei would prefer the larger banks right now, and she named NAB as one of those. Adam thinks it's just not yet time for Judo Capital, so he'd avoid that one. Higher costs for it, and we're watching those net interest margins and still waiting for them to be to rise. Mesoblast, Junbei says she's amazed this company is still listed. I think that says it all, and Adam would not avoid it. Don't bother sending him any emails this time around. He's heard your case, he's listening, and he's still not buying. All right, Metals X, it just doesn't excite Adam. In case you didn't hear it the 4 times he said it. Tin, not sexy enough. It's a sell for him, in fact, because again, we're in a pretty sweet spot with the commodity prices as we speak. They are cyclical. It's a hold for Junbei. She says it's in all the right places, but she would not be chasing it now. It is still a risky proposition. She would consider it if there was a pullback, but it's not a buy today. So that is what we've learned so far from our expert guests. Buy, hold, sell is still the name of the game, but we've got a new investment committee, and we put the buys to this investment committee once a month, and they have put together a high conviction fund. The portfolio so far looks like this. Equal allocation to BHP, Macquarie, Mineral Resources, Steadfast, Aristocrat Leisure, Audinate, CSL, NextDC, and Universal Store in the retail space. And then we have half units of Qantas and Frontier Digital Ventures. 20% is being held in cash. So every month the committee will meet to assess everything that we've learned through our episodes of the call, and they will see what they bring into the portfolio, what they pull out. So we'll give you a bit of insight into how real PMs put a portfolio together. And you can find the previous episode of the investment committee. It's up online now. And of course, we'll be getting one together for you in the next couple of weeks.
Grab a beer, grab a glass of wine, because this is where we just gossip It has been easy to get this bull market wrong.
Cheers to you.
Have a great weekend, everyone.
The Last Call is brought to you by Australian Vintage Wines. Invest in the home of Australia's premium wine brands.
In the next 30 minutes, we will discuss Breville Group, which did announce an acquisition just today, Paladin, to stick with one of our earlier themes, Openpay, Air New Zealand, and Objective Corporation. Let's get to it, shall we? Breville Group, this is for Shahana, a regular viewer, and gets a bit of advice or information on here as well. She says, can we please get the expert's view on Breville? The stock has been hit hard, but in her view, it was one of the standouts in the most recent reporting season. She points out that most brokers are bullish on the company. It's expanding globally. To that point, it bought that Italian coffee machine maker today. It's got favorable consumer trends behind it. So Shahana wants to know if it's time to buy the stock for a long-term hold. June Bay, what do you think of Breville? It's a company that has been confident enough to reinvest in itself as it really goes for that global growth.
Absolutely, it's a standout buy at this point. Really, it is a long-term stock. You know, you put in your bottom drawer, and you know, in a year's time, it will be a whole lot higher. This company's been hit recently because one is it's expensive. So now after the share price fall, it sort of still is about 30 times earnings. So it is in that expensive bucket because it is growing. Now also, it has a small exposure to Russia. I think it's between 1 to 2% of the revenue has, you know, that Russian operation, but that's going to be shut. But that's very, very small hit. And also the people are a bit worried about, you know, now the world reopens, are people still going to buy as much toasters and things? And it's been a beneficiary of the pandemic. You know, to remind you, a lot of growth of this company is coming from new territories. It has such a strong structural growth driver. It's not just a mature business that is becoming cyclical. So, you know, mature business will start having issues when, you know, consumers started going out. So all in all, I think the growth is intact and it is trading. Yes, it's expensive, but it's cheaper than what it used to trade at. So it is a standout, it's a quality business, and I will be buying it today.
Yeah, I'm with Jumbo on this one. Absolutely, it's a buy. You look at that chart and it looks really, really good down here as far as that it's had, you know, some peaks and troughs, but it's at that bottom level and it's a really good time to invest in it. I think overall that, you know, you look at their expansion into the US, it's done fantastically, and then they're obviously moving into other areas. This is a bit of an Aussie dollar, US dollar story as well, so just be a little bit careful on the currency because that could hurt you a little bit going forward. But overall, I think it's a standout buy. It's got a great management team, good balance sheet, and it pays a dividend as well. So I'd be okay to keep that one.
Okay, so that is a buy from Adam Dawes. Adam, you've mentioned charts a few times today. You do use charts and technical signals?
Yeah, so I think...
How do you incorporate that into your assessment?
Yeah, so we're basically, when we're looking at a stock, we look at all of the market research, so what brokers have got buyers, what the market's thinking, so the fundamental concepts behind it. We talk about, you know, commodity prices, fundamental, what is going on, but then you also overlay that with a chart or understanding where the price points are, where there's a floor or where there's a ceiling, so the top and the bottom, and if stocks have been moving in a trend or if they're breaking out of a trend, those kinds of things. I'm nowhere near a chartist as far as the MACDs and the RSIs and all the other stuff that people go on with, but I definitely think a chart does, and you have to respect some support lines and some top end or some resistance lines. So by doing that, it gives me a bit of a feel. So fundamental analysis say, yes, we like the story, BHP is fantastic. And a classic example of BHP is that our analyst, fundamental analyst, has had a buy on it from $50 all the way down to $15 through the GFC, back up to $50, back to $25 in COVID. He's had a buy on it all the way through. So fundamental, it's a buy, but it's then picking the levels where you think you would be able to, because when you're buying a stock and making money on a stock, you've got to buy at the right price. You can't just continue to buy wherever. You have to buy at the right price. And so using the chart as a level of support or showing where it is gives you some better or a better indication of where things are going at the moment. So yeah, not huge charting technology, but I do use it in my day-to-day, definitely.
Junbei, do you look at? I mean, I know I know that you look at price when you're buying. I know you look at price to know when to sell. How much do you give to sort of technical analysis, if anything?
Oh, look, I don't look at the technical, but Adam, is that a reflection of your analyst not being great in terms of picking the buy?
Well, you can talk to Rocky when you speak to him next, hey?
We pick our price points. So look, we don't count when we pick price point, but we look at relative valuation to the rest of the market and relative valuation to a similar group of stocks. So we're very tactical because I do long short. So, we make our 20%, 30%, we'll be selling it. And then we, buy back in when the share price comes back. We do look at trading range. For some stocks, they tend to get stuck in them, things like JB Hi-Fi and the like. But, we certainly look at, trading, being very, very tactical because the market, you need to be nimble. That's what you'll make most of the return. Yeah. So okay. Yeah. So that was my point.
Yeah. Okay. Good. I just thought I'd take a little bit of a detour there because I know we do get a lot of questions from our viewers on that front. Now, let's get to Paladin. It's next on the list. This is for Marty. Paladin is PDN, of course. Junbei, I think it doesn't need a lot of explanation, but maybe give your current thinking on what's been a very hot area of the market.
Look, I think, certainly for uranium is part of that whole renewable and, certainly has been under a lot of, got a lot of interest in into that space. But for me, it's a volatile space and, I'm just not stepping in at this point for that space. Paladin certainly is probably, the best one out of that group, but I'm not there yet.
Not there yet because we've got a lot of talk about nuclear. We've got a lot of talk about the Sprott Trust that's been buying physical uranium. It has been one of those sort of groundswell that you see people are just hardcore committed to the uranium stocks.
Well, they've had to be. For the last 10 years, uranium's done nothing. So it's finally great to see uranium actually starting to move in the right direction. So we're really bullish on uranium at Shores. We're really bullish on a lot of the companies inside of that sector. Paladin we've got a buy on, and certainly some of the smaller stocks. Paladin is probably the one that it's got the biggest market cap. It's able to move forward, and it actually looks pretty good here at the moment. It's obviously a speculative buy for us, so I'm going to say it's a buy in the uranium space. And there's been a lot of upgrades to Paladin as well as a lot of other stocks going forward. Obviously, the commodity price hitting over $60 a pound today, which is massive because of what Russia and Ukraine. I learned the other day that Ukraine's like the fourth largest producer of so many commodities around Europe that it is really struggling, and certainly uranium is definitely taking advantage of that.
Well, there's also
unrest.
lots of talk about energy security and nuclear, does play into that mix.
Absolutely, ESG even and all that kind of stuff. France talking about putting on some more reactors, those kinds of things. And Australia is in absolutely the box seat for uranium. We are the biggest producer in the world for uranium, and we have got a lot of yellow rock yellow rock cake in here in Australia. So absolutely. For ones for the speculative end of the market, Peninsula is a really good investment. We were just talking about that on the desk today. And then Vimy Resources also, both very, very speculative. Peninsula actually is one of the only companies in the world that can sell uranium into the United States. So that gives them a little bit of a tick there. Paladin has got a very large market cap, pretty hard to move, lots of shares on issue, but Paladin is definitely a speculative buy from me.
Got it. Thank you. That's for Marty. Let's get to, I think it's number 8 on the list, Openpay. This is for Damien. All right, Damien has given us some context. He'd like to know about Openpay, wondering if it's a hold or if it's a cut your losses. So potentially, Damien's a holder. He says, I know the market doesn't care what we bought at, but I'm trying to work out whether to sell, even though I'm more than 80% down, as it seems to be on a road to nowhere. Is it a hold? He doesn't have that much that he's holding. He likes the B2B aspect of Openpay, but really hasn't resulted in any positivity so far. So Junbei, already a holder, a small holder. It's been a terrible area of the market to be in, particularly with this name. So does he move on and cut his losses?
I would, because that whole buy now, pay later space, the world has changed. The funding cost is going to get higher, and it's already moving higher. And remember, for those buy now, pay later companies, they make very, very thin margin. And how they make money is require the capital to churn. So people borrow and return it very quickly, and they make a tiny margin, and then keep as profit. And most of them are not profitable at this point. Hoping, Zip and Sezzle, hoping at some point become profitable. Now, we know in this market now, because the margin is so thin, and then cost is rising for them. And then they can't increase their prices. So ultimately, they need to get bigger. The scale is so critical at the moment. Afterpay's merged with Block or Square, and you got Sezzle merged with Zip, and this Openpay is way too small. Just way too small. They need to get bigger. They need to become part of something else. And if they don't, I'm not sure if the business is viable.
Okay, so I'm not even going to say a buy, Adam. I'm saying, is this a hold or is this a sell?
So at Shaw & Partners, we cover Openpay. We have a buy on it.
Why?
Well, we've reduced our price target from $3.50 to $1.25.
You're towing the line right now, Shaw &
I am
Partners.
towing the line at the
Sorry, I have to act on behalf of my viewers.
Yeah, so look, it's not a buy. It's struggling, and there's a couple of reasons. Obviously,
Look at that.
You want to talk about charts? Don't look at that chart. Look, a high probability of rising interest rates is going to be tough over the next coming couple of years. Withdrawal of government stimulus, which has been a huge boom to retailers, that's going to obviously coming out. Surge of cost of inflation is also something that's not going well. China's slowing down, and obviously without stimulus going forward, and not that they do a lot in China, but that's talking about that. And geopolitical tensions is obviously putting things on the back foot for this one. However, this does trade at a 45% discount to the rest of the buy now, pay later, and that's the why we've got a buy on it. They trade 45, below its peers. EV to sales is about 1.5 times versus 2.7 times for the rest of it. But Junbei is absolutely correct. These margins are absolutely razor thin, and you have to do a lot of transactions to get that margin, or at least to maintain that margin. And that's where it's really, really tough for these smaller players. There will be some more consolidation in the industry, and certainly if you've got it, probably potentially hold it for maybe some more consolidation. But it's really been a tough space at the moment. So I don't know, did I say buy, hold, and I'll probably say sell as well. I don't know. It's a hold. It's a hold, because I've got to stay with my analyst, and he's got to buy. But it's a
Well,
tough
you're not
place.
staying with your analyst. But anyways,
I'm moving on.
Sorry, Adam, I love you. That was not your finest moment.
It wasn't.
Damien, you take your pick as to who you're listening to on Openpay. I'm agnostic, as you know. I'm just here to move them along when needed. Okay, let's go to Air New
Moving
Zealand
on.
then.
Yes.
Shall we? AIZ is the ticker code. Junbei, I'm starting with you on this one. Let Adam recover.
Look, airline, first of all, there's a few issues with that. Well, first of all, with Air New Zealand, it's heavily indebted. It hasn't raised sufficient enough funding like Qantas did, a couple of years ago during the pandemic. And so it's been mooted. There's a material capital raising coming. That's why share price is not moving. But that is, we don't know how big it is. It's going to be dilutive. Now, secondly, airline was meant to do better now that given, reopening and things. But we all know the different variations of the virus has deferred that process. So they're not making money if you don't start flying. And the problem is that with the oil price where it is, the oil price moving from 80 to 110 or under 110 just in 1 week, it will put a lot of pressure for airlines that don't have sufficient capital to try and hedge. Now, Qantas, if you want to play airline, the best operating airline is Qantas. It will give you, Qantas is 90% hedged until June, and then for the next 12 months is reasonably hedged. And if anything, Qantas operates within Australia a very rational market. If they need to recover some of the fuel costs, and the prices will go up. I don't know if you noticed. We try to go to, and the air ticket prices has gone through the roof. So honestly, if you want to play airline, go to Qantas. At this point, Air New Zealand just pretty tough at the moment.
Okay, yeah. Jimmy, I was a bit surprised yesterday. I was a bit surprised that we saw some of the travel names on the top of the buy list. Don't even know what camera I'm looking at. There we go. Because we've got all this uncertainty out there. Yes, we saw oil prices come off a bit. That was the only sort of connection that I could make. But they seem they're so volatile these days, aren't they?
I think they all trade on sentiment at the moment. But I tell you one thing that's interesting. Corporate travel intention has gone up actually quite a lot in the last couple of weeks. I don't know why. And this is across Europe, US as well. In Australia, as I mentioned, try to book some the interstate ticket. And within a few days, ticket prices have all gone through, 20-30% increase, probably 15. So, and then you go through the airport, it's completely packed. So, corporate travel is actually holding up pretty well. It's the leisure side, potentially there's been some impact in terms of Europe. But, I think overall investor, we want to buy travel because we know it's coming, that multi-year travel boom. Just at this point, it's a bit risky because, who knows how long this war lasts and how bad it might be. And but it's certainly, I think, in the corporate travel side, it looks quite interesting.
Okay, interesting. Yeah, I had a conversation yesterday, just, whether or not people are going to be flying for business now. And the consensus around the table was, yes, it will come back.
Yeah, absolutely.
Air New Zealand, what do you think of Air New Zealand?
I'm with Junbei. Qantas is the better business, the better run airline, and probably one of the best in the world. So what Qantas did that Air New Zealand didn't do is, as Junbei rightly pointed out, that they didn't raise any new equity capital. They went to the government, and the New Zealand government funded them for about $2 billion New Zealand dollars, $2 billion New Zealand dollars to finance and support the business. And so really what's happened is obviously the government's taken a stake in their national carrier, which I think is the right thing to do. But those losses that will be continually heavily going forward. Also, the International Air Transport Association estimated that the global airline industry has losses from 2020 to 2022 of $201 billion. That's huge. There's massive amount of money that's been lost in this space. And certainly Air New Zealand obviously didn't have a fantastic first half as well. Obviously, with the closure of New Zealand borders, that has been really, really tough, and that's deprived the airline of about 2/3 of its regular tourism travel or regular travel. And certainly with new wave that's potentially coming through, that might also impact these guys as well. Winter coming up, you'd like to see everyone coming down to Queenstown to do some skiing and things like that. But really, it's all about that fully vaccinated status, and really then having to isolate in their community for up to 10 days, which just stops people travelling or moving around. So it's going to be really tough. But I think overall, Air New Zealand is having to rehire a lot of people, so costs are going to go up. They had to sack or make 250 cabin staff, air pilots redundant. They've got to try and get them back, which means they have to retrain and get them in the air again. So there's a long lag to what's going to happen. So I think this one is a no from me. Qantas is definitely the better buy in that space.
Got it. Thank you. Look, lucky last is Objective Corporation, OCL. This is for Scott. So there's not a lot of context around whether he already holds it or if he's just interested in it. But it is basically a software company that primarily targets government, and it looks to move them onto the cloud and facilitate, work from home and everything else. So check all those boxes. But as you all well know, tech has come under such pressure lately. So I suppose the question is, it's down close to 18% year to date. If it is a fundamentally good business and the baby's been thrown out with the bathwater, Junbei, is Objective Corporation a buy, hold, or a sell?
Yeah, look, I think it's come off. I would put in the buy basket. It's yes, it's expensive, but it's a very defensive business. Got big government contracts, and it's been growing year in, year out. And it's a very good track record of generating, organic growth rather than go out and buy things. So that's very high quality growth. And at the same time, the margins are enormous for this company. The only thing is liquidity is not very high for this company. The founder they still hold 65% of the shareholding, and then the business is still founder led. So for me, I do like to follow management like that, because they have a vision to really grow this business, significantly over the years. I will put that in the buy basket.
Buy basket. Just to put it in perspective, so to Junbei's point, yes, it's come under pressure year to date. Over the past 5 years, it's up close to 700%.
Wow.
Yeah. Founder-led. A lot of people like founder-led businesses.
They do, until they want to sell out. But anyway,
okay. Putting that to one side, would you wait for one of those days, and we've had a number of them lately, that infotech as a sector is down 5-6% to look to buy in?
Yeah, yes, I think so, absolutely. It looks good. I mean, they've got deep relationships with Microsoft 365, so that's fantastic. They're driving a higher quality of customer, which I think is really successful to the business. And some of the financial highlights, revenue was up 13% to 53 million. ARR, so annualized recurring revenue.
Everybody likes that.
That is the tick. That was up 13% to $79 million as well. So that alone is fantastic. And if those margins are what Junbei says, then that's absolutely going forward. They've got cash around $44 million. And there was a net profit after tax of 10 million, still a little bit, but still 40% up, but still a little bit small on that one as well. They've got some really good businesses or divisions in that, and they're all looking at double-digit growth as well, which is what you need in a tech business, because nobody looks at you if you've got single-digit growth. It's just impossible. So look, I think overall, if they can predict, or we can get some better earnings predictability with a lot of their subscription revenue, it looks pretty good. So I'm going to go with Junbei as well. I think this one, it looks good for that tech space. There's certainly better ones out there, but I think this one looks really good. So I'm going to stay with Junbei and go a buy on this one.
That will be put to the investment committee. Adam, what other ones in the tech space are you thinking look interesting because they've been sold off?
Well, Xero. I mean,
everybody says Xero.
I keep going. I bought some the other day, and I'm underwater, not personally, but for clients. I thought, look, 100, sort of 99 looks pretty good. It was 95 today when I left the desk. It's getting washed around, but this is a fantastic business. It's just one of those hard, fantastic growth businesses. Will do very, very well in that space. So I have to stay in the big sector or at the top end, and Xero is one of those ones that I really, really like.
Junbei, I'll just get a thought from you on Xero. It's trading at 93.65, so yeah, quite a bit below. Sorry. Yeah, it's down 5%. It's
Yes,
one of those days.
I know.
Would you buy Xero on a day like today?
Yeah, you will be. I think, out of the whole tech sector, Xero is one of the top pick. And when it goes down like this, you never know when it's the bottom, right? So you just got to slowly build your position. But relative to tech sector, I actually grouped the healthcare as well. So, don't forget, when we talk about growth, all of them have been sold off. Time to really revisit the growth, the traditional growth defensive sectors such as healthcare. CSL is still down relative to in the last couple of months as well, and they are doing, they will do very, very well, and these are profitable businesses, highly cash generative, and then its earnings growth is, it's not really linked to the global growth or not. So it's time to visit the healthcare space in the large cap space at the moment.
Okay, well, Junbei, we'd love to have you on to talk about healthcare in particular, maybe in the next couple of weeks, but I'll leave that there. Let me just summarize what we've learned in the second half. We've got a couple buys out of this with Breville Group. Breville Group is a standout buy. In Junbei's view, it's a quality company. Adam says the management is doing a great job as well. It is a buy from him. Just keep an eye on the Aussie dollar in Adam's view. Paladin, uranium is just too volatile for Junbei. It's not proved itself to her just yet, so she's staying away from Paladin. It's a specky buy, though, for Adam because he's bullish on the whole story around the metal and Australia's position in the world. He says we've got a box seat there. He mentions Peninsula and Vimy, so you might want to do some research on those yourself as well. Openpay, it is a sell for Junbei because the world has changed. She says cut your losses, the margins are thin. Adam doesn't disagree with any of that sentiment, but he is holding because he says it looks cheap. Air New Zealand is a no for Adam. He says Qantas is the airline you'd like to be in, and Junbei agrees. She also talks about corporate travel and how, in her view, it is coming back. So watch that one. You need to really keep in mind with these airlines now, particularly, their hedging levels for the price of oil. Objective Corp, here's another buy from both of our guests. You just heard them talking about it. We'll leave it there. Xero as well, I think, is the bonus buy for today. That is the program. Junbei, I'll start with you just to say a big thank you. We do hope that you enjoy your weekend, and we'll see you soon.
You too. Thank you very much. Thank you for having me.
Thank you. And Adam Dawes from Shaw & Partners. Always a pleasure to have you in.
Thank you.
Yeah, have a good weekend as well. We've got Weekend on the Mind here. If you'd like to join us for the last call today, feel free. It's live at 4. We wrap the day and the week. Now, if you have any stocks you'd like us to cover, you can flick us an email, the call, at ausbiz.com.au. You can find that portfolio still at ausbiz.co/portfolio. Next on the small caps, I'll be speaking with Mitchell Atkins from Magnolia, founder and CIO. Stay with us.
Bye.